Now, another major aspect of advising people about contributing to an IRA account or even to a 401k account, any kind of retirement savings, is there's a particular tax credit called a Retirement Savings Contributions Credit. Now, the purpose of this credit is to encourage middle and lower income taxpayers to save for retirement. Now, with all the problems that Social Security system may be having in the future, that it's projected to have, this is one thing that the government is doing to try to encourage those middle and lower income people to save for retirement. Now, this credit is probably one of my favorite credits that's around right now. It's very powerful, especially, it's very valuable, especially for someone in the lower income. Okay, so let's say that someone makes $30,000. They may be able to get up to a 50% tax credit for their contribution to their IRA account or even their 401k, any kind of qualified retirement account. Now, if you get a 50% tax credit for your contribution, that's something that makes it much more appealing, right, to make that contribution, because you're going to save tax money right now. Remember that tax credits, unlike deductions, you don't just make the marginal rate, right, the deduction amount, but you make actually dollar for dollar. So let's say, for example, that you have a client who qualifies for that maximum 50% tax credit, which is the Retirement Savings Contributions Credit. That person puts in $2,000. They may be able to get a $1,000 tax credit based on that contribution. Now, if you can get a $1,000 tax credit for putting in $2,000, that makes it extremely appealing. And not only can you get the credit, in some cases, this doesn't work for every case, but you also can claim a deduction if you're contributing to a traditional IRA. So let's say that taxpayer is making $30,000, $25,000 for the year. They may not feel, hey, I don't have enough money, I'm barely making my bills now, I don't have any money to save for retirement. But if you are able to make that contribution, they will get an excellent return if they can not only get the deduction for the traditional IRA, right, but they can also get the Retirement Savings Contributions Credit. I'll give an example. Let's say that taxpayer is paying 15% federal income tax rate, 5% state. Let's just sketch it out like that. So that's 20%. They put in $2,000 into that individual retirement account, traditional IRA, right? So they get a deduction, 20% of that $2,000, that's $400, okay? So that's $400 of tax savings. But you can further juice the return on that $2,000 contribution if the taxpayer qualifies for the maximum 50% credit, Retirement Savings Contributions Credit, right? That's an extra $1,000. So $1,000 plus $400, that taxpayer is now getting a return on that $2,000 investment of $1,400, right? So because they would have paid that $1,400 in taxes in the current year. So that's an excellent return. That's a 70% return on that taxpayer's $2,000 that they put into the account. Now, you're going to be very, very hard pressed, and I might even say that it's fairly impossible to get a 70% return on your investment immediately, because you're saving that money in the current tax year. So that makes it more appealing for someone who's lower income to have this kind of conversation. And they may say at first, well, no, I'm not interested in IRA, that doesn't make any sense for me, I don't have enough money to make my current bills. But let's say they can come up with an extra $500 or an extra $1,000 and make that contribution. They not only can pick up the deduction in many cases, but also the Retirement Savings Contributions Credit, which can be a very nice credit to get and can really make it worth it for that lower or middle income taxpayer to say, hey, you know what, I'm going to come up with that money because I know that's a smart thing to do. And you want to stay away from telling clients, oh, you need to do this, but if you're going to get a 70% return on your investment, it's definitely something that's worth considering. And so that's a conversation that you might have with a middle income or a lower income person who's thinking about starting an IRA account or making a contribution to an IRA account. So like we said, this is likely an interaction that you're going to have with the client as they're actually sitting down at your desk. And a lot of reason why people have questions about IRAs or the tax savings involved with different retirement plans is because they would like to reduce their current tax bill. And remember, we said that the IRS and the government gives you the ability to backdate that contribution. So that client can be sitting with you today, the year's already passed, they can, after they do their taxes, go down and put in that IRA contribution amount, backdate it for the previous year, and take a deduction or take a credit. One group of people that you'll frequently see considering this is someone who is working, so they're still working their job, but they're also receiving Social Security pension, okay, pension income. Now, as you know, if you've looked in your textbook, Social Security income is taxable or becomes taxable when you have a certain amount of other income, okay? And that is always the case when the person is still working. So let's say you have someone who is in their mid-50s, okay? Or excuse me, not their mid-50s, their mid-60s. So they're 65 years old. So they're still working, they may be making pretty good money, but they started drawing Social Security. They're going to have to end up paying income tax on a large portion of that Social Security income. And so they may be sitting there at your desk saying, wow, I wasn't thinking I was going to pay income tax on this Social Security, and this is really driving up my tax bill. When you put the wages from the job, right, together with the Social Security income, one thing that someone can do, and this is a little bit of an advanced trick, but it's something that I want to make you aware of, is that if that person was to make a contribution to a traditional IRA, it can reduce their taxable income, right? And it can thereby reduce the amount of income tax that they're having to pay on the Social Security benefit, okay? So it can make less of the Social Security pension taxable. Again, a little bit of a complex idea, or even better might be, say they have a 401k plan at their job. They can start, as they're 65 years old, they can start funneling or diverting more of their wages into that 401k account, okay? And that's going to make their income show up as lower on the tax return. It's going to give them an extra deduction, so to speak. And it's not only going to give them the benefit of that deduction, but it can, a lot of times, it can lower the amount of the Social Security income that's being taxed. So again, you're getting a sort of double benefit. And overall, the key point on doing these kind of advising sessions or having these kind of conversations is that you have a very great tool in your tax software to be able to, as you're talking to somebody about this kind of things, just test it out in your software and say, hey, if you were to make a $1,000 IRA contribution when you leave this office today, you would receive a benefit of this amount. You know, and you can literally test it out with your tax software and see down to the dollar figure, oh, this is what that $1,000 contribution would be worth, okay? This is what you would save by doing that. And so by having those kind of things, those kind of conversations, you're going to be having a high-level conversation with that taxpayer, and you're going to be giving them, hey, this is a way to protect your income from being taxed. This is a way to be smart about saving for retirement. And so when you're well-schooled in this area and you know these little tricks of the trade, people are really going to respect your expertise, okay? So again, it's that idea of you're not just preparing the tax return or doing data entry, which anybody can do, or that person can do on their own, most likely, can just go online and start plugging in information. But now you're actually having a conversation and you're using your knowledge, okay? Your knowledge as a tax consultant, as a tax expert, to advise your client, okay? And I want to reiterate in closing here that you want to be very careful about advising clients in a financial advisor sort of way. So you don't want to tell them if you think that Google stock is a great pick, or you just love Microsoft stock. Stay away from that kind of thing and really stick to the tax aspects of investing in an IRA or in a 401k. And you just don't want people to be able to come back and say, oh, well, you told me I should advise in an IRA, and then the stock market tanked and I lost all my money. Okay, that's happened a couple times over the last decade. So you don't want to be responsible for that. You want to leave the ball in the taxpayer's court, in your client's court, and say, hey, this is something that I want to show you. If you were to contribute to an IRA account, either traditional or Roth IRA, hey, these are some benefits. These are the exact numbers that you would save by doing this. You may be able to pick up an extra tax credit, that retirement savings contributions credit, or you may be able to shield more of your Social Security income from being taxed, okay? So those are tax benefits that are associated with that, but you don't want to tell the person, oh yeah, you have to do this. If you don't do this, it's a really dumb move. You want to give them the option, show them the numbers, and really have a conversation with them about their money, because ultimately it's their money. What they choose to do with it is really up to them, at the same time, you want to show your value as a tax expert by giving them good advice, good information. And when you take that extra step of not just preparing the tax return, inputting the information, but having a more high-level conversation about tax savings and retirement, you're going to be showing value, the value of your service to that taxpayer, and they're likely to be a client of you or your client rather than somebody else who's not taking the time to talk about those kind of things, but is just inputting the information, which, like I said, at this point, it's not hard to find the software. People can do it themselves. So you have to find out, how can I add value to the client? And being aware of these different tricks of the trade with regard to IRAs is one major way that you can show your value as a professional tax preparer.